Historically, if you look at this table, the median average decline of a bear market is about 28%. Well, just to put that in perspective, the peak to the trough that we've seen recently, if that were to hold, would be a 24% decline in the S&P 500. And also what history suggests to us is that investors actually come in and buy during these weaknesses, that they end up, as you can see on this chart, delivering very solid returns in the next 1, 3, 5, and 10-year time frame. So at this point, we would not look at selling into this. Instead, look at what the market is pricing in. Focus on areas of the market that have already priced in the downside risk. Now, we do think from a U.S. large cap space, there still may be some room for that to see further weakness as we navigate through this inflation and Fed tightening cycle. But if you look at small and mid cap stocks, these stocks have fallen, in some areas 40% from peak to trough. They've significantly underperformed, and we've already seen that their earnings have been slashed to kind of reflect this downside risk. So in this environment, this is a time that we'd be adding to these types of areas. Another area that we continue to like that's been underloved, underperformed, and we're looking at valuations at historically cheap levels compared to the U.S. is the international markets. As we come out of this recession, these areas that have been the most beaten down, that have priced in the downside, these are the ones that you want to be in because they're the ones that will rally the most coming out of it. Now, we'll continue to look at our equity allocation, but at this time we're focusing on those areas of the market that have reached that peak pessimism, that have priced in the downside from an economic and an earnings perspective.